Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into FTAI Infrastructure, trading under the ticker FIP.
Right, and there's a lot to cover here.
FIP is executing a deliberate, highly transformative corporate turnaround that prioritizes structural deleveraging, intentionally divesting its flagship Long Ridge power asset to shed billions in associated debt. This strategic pivot creates a significant liquidity event, enabling the company to transition toward a pure-play freight rail compounding engine while improving its overall interest coverage profile.
Yeah, I mean, it's honestly a phenomenal case study in corporate survival
Yeah.
and just reinvention.
It really is. You're watching a management team actively dismantle, the very thing they were known for. They're fundamentally rewiring their balance sheet and their identity just to save the core of the business.
Exactly. They had to completely gut the house to save the foundation.
And that is the exact anatomy we are here to dissect for you today, so welcome to the deep dive. Our mission today is to totally decode this massive corporate pivot.
And for those of you tracking along at home, we have a pretty towering stack of source material today.
We really do. We're going through the SEC 10K and 10Q filings. We're reading between the lines of the Q1 2026 earnings call transcripts.
Right, and we're also cross-referencing a flurry of institutional analyst reports. Plus, we're breaking down the ink on the June 2026 Tidewater Logistics acquisition announcement.
Yeah, that breaking news from June is huge. We are going to figure out how a company drowning in conglomerate debt is basically carving itself down to the studs to build a highly profitable pure-play logistics and rail empire. Okay, let's unpack this.
So to truly grasp the magnitude of what FIP is attempting here, we have to put ourselves in the room with their executives at the close of Q1 2026.
Right, because if you are looking at their financials from that quarter, you aren't just seeing a company going through a rough patch.
Not at all. You are looking at a severe systemic leverage crisis.
Yeah.
I mean, you open up the consolidated balance sheet, and sitting right there on the liability side is $3.84 billion in total debt.
Billion with a B. And let's ground that number for a second, because $3.84 billion in debt is abstract until you compare it to what the company actually owns.
That is the critical context right there. They were carrying that $3.84 billion against a negative equity position.
Wait, negative equity?
Yeah, a negative equity position of $303.1 million.
Oh, wow. So they were completely underwater.
Completely underwater. In operational terms, they were running at like a 14 to 15 times debt to EBITDA ratio.
Which is astronomical, right? Like,
Oh,
for
I know.
anyone modeling this out, a healthy infrastructure company usually sits somewhere between 4x and 6x.
Exactly. So pushing 15x means you have virtually no margin for error. And the sheer gravity of that debt load was just crushing their day-to-day operations.
I mean, the first quarter of 2026 alone, FIP reported a net loss of $127.2 million.
But the true killer wasn't operational failure, right? It was the capital structure itself.
Yeah, because of that $127 million loss, $82.5 million was purely quarterly interest expenses,
Right. Let that sink in.
which means they were bleeding over $80 million every 90 days just for the privilege of holding their assets.
You aren't really running an infrastructure business at that point.
Hmm.
You're just a middleman collecting revenue to hand directly over to bondholders and commercial lenders.
Yeah, the treadmill was set to maximum speed, and they were exhausted just trying not to fall off. The cash flow was totally trapped.
They couldn't deploy capital to maintain their rail lines or upgrade their port terminals because, the debt servicing demanded every single spare cent.
Right, management knew they were paralyzed, which forced the extreme measure we're looking at today.
Yep, the $1.52 billion sale of the Long Ridge energy and power asset to Emeria Holdings.
Now, this transaction is fascinating on multiple levels, especially when we look at the buyer. MRA Holdings is traditionally a massive player in Bitcoin mining and digital infrastructure.
Right, they mine digital assets.
So, on paper, it sounds like a totally bizarre pairing. Like, why on earth is a digital asset miner dropping $1.52 billion on a traditional combined cycle gas power plant in Hannibal, Ohio?
Well, because Emery isn't looking at it as a traditional power plant. They're looking at it as the ultimate ready-made digital infrastructure ecosystem.
Okay, break that down for us. What is the physical asset here?
Let's look at the specs. Long Ridge is a 485 megawatt combined cycle gas plant. It was brought online fairly recently in 2021.
So it utilizes state-of-the-art turbines that are incredibly efficient.
Right, exactly.
Yeah.
But if you dig into the analyst reports, the turbines are really only half the story.
Yeah.
The real prize for a company like MRA is the dude it sits on.
The land?
Yeah, the transaction includes over 1,600 acres of contiguous land that is heavily permitted for heavy industrial use.
So it's essentially just a plug-and-play campus for hyperscale computing?
Precisely. I mean, think about the bottlenecks facing digital infrastructure and AI data centers today.
Right, it's power.
Yes, the biggest hurdle isn't buying the server racks right. It is securing the massive, uninterruptible power required to run them, and then navigating a total maze of regulatory zoning to build the facility.
Yeah, which takes years. But Long Ridge hands MRA an instant 485 megawatts of behind-the-meter power.
Right behind the meter, meaning they generate their own electricity on-site without relying entirely on a constrained local grid.
It entirely bypasses years of what we call greenfield development friction. MRA gets to skip a decade of zoning hearings and environmental impact studies.
It's a brilliant move from MRA. But you know our focus is FIP and how that $1.52 billion physically moves through their balance sheet.
Yeah, because as we've discussed before, a corporate asset sale isn't just a giant direct deposit into a checking account.
Right, there are strict accounting mechanics at play here. Let's do the deleveraging audit on this cash.
Okay, let's follow the money step by step.
Yeah.
Because the first massive chunk of that transaction, $1.16 billion of it, never really touches the parent company's discretionary accounts.
No, it goes directly to wiping out the Long Ridge subsidiary level debt.
And for anyone who doesn't live in corporate finance spreadsheets, we should definitely define what subsidiary level non-recourse debt actually means, because it's a really crucial distinction.
It is a massive distinction. Non-recourse debt essentially means the loan is ring-fenced around the specific asset.
Okay, so when banks loaned the money to build the Long Ridge power plant, the agreement was that if the project went bankrupt, the banks could seize the power plant.
Right, but they could not come after FIP's other assets like their railroads or ports. It was isolated risk.
Oh, okay. So by selling the plant to MRA, that specific $1.16 billion debt bubble is cleanly severed and just floats away with the asset.
Exactly. It instantly vanishes from FIP's consolidated balance sheet.
Man, that's a huge psychological and financial haircut. But you still have roughly $360 million left over from the sale proceeds. Where does the rest of the cash go?
This is where FIP actively changes its corporate trajectory. Because the subsidiary debt disappearing is great, but it doesn't solve the cash burn at the top level.
Right. The parent company is still hurting.
Yeah, so FIP takes the remaining net proceeds and targets the most painful high-interest debt sitting at the parent company level. They are executing a $300 million paydown on a specific corporate term loan.
And that term loan carries a brutal 9.75% interest rate, according to the filings.
Right. And paying off a loan with a nearly 10% interest rate is basically an immediate guaranteed return on your money.
So how does this double move, the subsidiary wipeout plus the $300 million term loan paydown, actually shift their terrifying 14 to 15x leverage ratio?
It completely rewires their debt coverage profile. Management projects that this move will drive their corporate debt-to-parent level cash flow ratio down from a precarious 9.5x down to a much healthier 7.4x almost immediately.
Wow, down to 7.4x.
Yeah, and that is just the baseline stabilization. Their stated near-term target as they continue to integrate their assets is to push that ratio all the way down to 5.1x.
Okay, I have to stop you right there and play devil's advocate for a second, because I'm looking at the revenue figures from the 10K and I see a glaring contradiction.
Okay, lay it out.
Well, Long Ridge was an absolute cash machine. It was generating $144 million in annualized adjusted EBITDA.
That is true. It was highly profitable.
Right, so that is an enormous amount of guaranteed cash flow. Aren't they essentially selling their golden goose just to pay off the mortgage? I mean, why not just hold the asset and use that $144 million a year to service the debt or try to refinance the term loan?
If we connect this to the bigger picture, I see where you're coming from, but you have to look the cage the goose is in.
Okay.
Yes, it throws off $144 million in EBITDA, but it costs over $1 billion in debt to maintain that cage.
The interest was eating it all.
Right. Furthermore, if you consider the macro environment in early 2026, refinancing a billion-dollar fossil fuel power asset isn't getting cheaper. Capital markets are demanding way higher premiums for carbon-intensive infrastructure.
Sure, but selling your most profitable asset when your balance sheet is distressed usually signals desperation, right? The market often punishes that, assuming you sold at a massive discount because you were backed into a corner.
Normally, yes. A forced sale yields pennies on the dollar. But that's where the MARA Holdings dynamic bails them out. FIP didn't sell this as a distressed power plant.
Right, they sold it as a premium digital infrastructure site.
Exactly. But beyond escaping the debt, it's about shedding a massive valuation penalty known as the conglomerate discount.
I see, because prior to the sale, public markets just didn't know how to value FIP. They were this confusing Frankenstein of a company.
Yeah, you had power generation, gas reserves, railroads, and deepwater ports all matched into one single ticker symbol.
Right, so if you are an institutional investor looking for stable railroad dividends, you don't want the extreme volatility of wholesale natural gas markets polluting your investment.
Exactly. And if you are an energy trader, you really don't care about short-line railroad logistics. FIP was heavily discounted because they lacked a cohesive narrative.
So divesting Long Ridge fundamentally changes the identity of the company. It allows them to pivot cleanly into a pure-play, specialized rail and terminals operator.
Right. You think about it, FIP was walking around carrying all this extra heavy fat, right?
Yeah.
The power generation, the $1 billion in project debt.
It might have been profitable fat, but it was weighing down the entire organism.
Precisely. They've aggressively, surgically trimmed all that away. Now they're just the spine, just the backbone, pure rail and ports.
But the bank being happy is only half the battle. Trimming the fat doesn't actually generate new revenue. To survive, they have to make the remaining muscles, those railroads, actually work together. And that introduces a completely different operational nightmare.
Which brings us to the new heart of the company. Now that the power and gas distraction is fully gone, FIP's entire future rests squarely on the freight rail segment.
Let's define this new core for everyone, because these aren't just little toy train sets. We are talking about two massive, highly complex acquisitions.
Right. Let's look at the timeline.
First, FIP bought Transtar back in 2021 for $640 million. Transtar is essentially a network of short-line railroads that historically service the heavy steel industry in the Midwest.
Yep. And then, much more recently, in late 2025, they closed a mammoth $1.05 billion acquisition of the Wheeling Corporation.
Which is commonly referred to in the industry as the Wheeling and Lake Erie Railway, or WNLE.
And Wheeling is a beast of an asset. It is one of the largest regional Class II freight railroads in the entire United States.
Yeah, the scale is wild. It operates over 1,000 miles of tracks sprawling across 4 states, right? With Ohio, Pennsylvania, West Virginia, and Maryland?
Correct. On an annual basis, it handles over 124,000 carloads, moving everything from crude oil and aggregates to chemicals and heavy machinery.
So you have these two giant legacy rail systems under one corporate umbrella. You've got Transtar handling the steel mills and Wheeling handling the broad industrial transport.
Right, and it sounds great on a PowerPoint slide. But digging into the sources, you quickly encounter what the analysts are calling the integration paradox.
Which sounds like a headache.
It is the central conflict threatening FIP right now. The integration paradox is the reality that in order to achieve the massive long-term profitability that justifies a billion-dollar acquisition, you first have to endure severe margin-crushing short-term pain.
Right, you have to spend money to stitch them together.
Exactly. FIP is facing intense near-term liquidity headwinds, which we just saw reflected in those massive Q1 net losses. Yet they have absolutely no choice but to push through the short-term administrative friction and management distraction required to integrate these really complex assets.
Let's get specific about this administrative friction, because it sounds like corporate speak. But when you look at the 10Q for Q1 2026, it translates to real hard dollars bleeding off the income statement.
Oh yeah, the numbers are right there.
I mean, I'm looking at operating expenses, and they jumped by a staggering $23.8 million in a single quarter.
Right. Furthermore, acquisition and transaction costs rose by $1.5 million, entirely tied to the W&LE consolidation.
Because merging two railroads isn't just updating a logo on a locomotive, right?
No, it is a logistical and human resources nightmare. When you are combining 1,000 miles of wheeling track with Transtar's 6 separate short-line operations, the complexities compound exponentially.
Right. What specifically?
Well, first you have the IT systems. Railroads run on incredibly complex dispatch and positive train control software.
Right, for safety and routing.
Exactly. If Wheeling uses a legacy system from 2010 and Transtar uses a different vendor entirely, you have to spend millions on consultants and new software just to make sure the dispatchers can talk to each other without causing a derailment.
Not to mention the human element, you are dealing with multiple different union contracts across all these states.
That is often the most expensive friction point. Reconciling different collective bargaining agreements across different states means you have to negotiate new seniority lists.
Oh, man. Yeah. Aligned pay scales, standardized safety protocols, all of that.
Right. And physically, you have to optimize maintenance.
Yeah.
If you have 17 different rail yards across the new combined network, you have to figure out which ones to close, which ones to upgrade, and how to standardize the spare parts inventory for hundreds of locomotives.
So that level of physical and administrative consolidation requires massive upfront spending before you see a single dollar of efficiency.
Yeah, you take the hit on the chin in the short term, hoping the long-term payoff is actually worth it.
And the prize at the end of this tunnel is what they call the synergy target. The sources indicate management has mapped out a long-term cost synergy goal of $23 million annually.
Right, and despite the pain the earnings call transcript shows, they are making aggressive headway on this.
They are. The CEO explicitly noted that they already enacted $10 million of this annual synergy target in Q1 alone.
Which is huge. For that specific quarter, it translated directly to a $2.5 million boost to their adjusted EBITDA.
And they didn't achieve that through magic, right? They achieved it through hard structural changes.
Exactly. They executed personnel reductions in duplicative management roles. They leveraged their new combined size to negotiate better purchasing power for steel rails and locomotive diesel. And they slashed overlapping corporate overhead.
Cost cutting is vital, but, you can't shrink your way to a rail monopoly. You have to actually grow revenue.
You do.
Well,
And there's an incredibly fascinating detail buried in the Q1 earnings call regarding U.S. Steel that highlights how FIP plans to grow organically.
right, for context. Nippon Steel is currently executing a massive $11 billion investment into revitalizing U.S. steel facilities.
Yeah. Now, $2 billion of that is earmarked for a plant down in Arkansas, which is totally outside FIP's geographic footprint.
But the CEO of FIP made a very pointed comment about the remaining $9 billion. He expects it to heavily benefit the Mon Valley Works in Pennsylvania and the Gary Works in Indiana.
Which is the exact logistical sweet spot for FIP. Transtar's legacy short-line railroads were literally built to service the Mon Valley and Gary Works facilities.
Okay, so if Nippon Steel is pouring $9 billion into refurbishing aging blast furnaces, upgrading technology, and significantly increasing production output at those specific sites.
Transtar is the exclusive logistical artery that will carry that increased output to the main rail lines.
It's the ultimate piggyback, right? If U.S. Steel produces more coils of steel, those coils have to be put on a train.
Yeah. Exactly. More steel production translates to more carloads, and more carloads mean direct organic revenue growth for FIP. All without FIP having to spend a single dime on laying new rail lines or acquiring new customers.
It highlights the embedded value of their network perfectly. But relying purely on organic macro growth and internal cost-cutting isn't enough to build an empire.
No, they are pairing this with a strategy of highly targeted, disciplined acquisitions. They want to ingest new cash flow to accelerate the turnaround.
Which leads us directly into the breaking news from the sources regarding the Tidewater deal. Here's where it gets really interesting.
Yeah, this just happened.
On June 29, 2026, literally weeks ago, FIP announced the acquisition of Tidewater Logistics for a total cash consideration of $45 million.
And let's look at the financing math first. They didn't issue new shares and dilute the stock, right?
Right, and they didn't go out and secure a massive new high-yield bond either.
No, they bought Tidewater simply by upsizing their existing term loan with their current syndicate of lenders.
And the return on this deal is immediate. According to the announcement, Tidewater is expected to generate $9 million in adjusted EBITDA over the next 12 months.
If you perform a strict forensic audit of those acquisition metrics, the financial brilliance of this specific transaction becomes totally undeniable.
Yeah, let's do the math on the multiple.
They acquired this business at a 5x multiple. You take the $45 million purchase price, divided by the $9 million in expected EBITDA, and you get 5x.
Wow, only 5x.
Right, in the current infrastructure environment, where assets routinely trade at 10x or 12x multiples, capturing a cash-flowing logistics asset at 5x is highly, highly attractive capital allocation.
It's basically a steal. But they aren't just buying it because it's cheap standalone revenue, right? Tidewater isn't an isolated business.
Oh, not at all. They are a barge and rail transloading specialist with operational facilities strategically located in Ohio, West Virginia, and Texas.
So by ingesting Tidewater, FIP is actively balancing the cash flow baseline of their entire terminal segment.
I mean, it is entirely about the network effect, right? Transloading, for those unfamiliar, is the physical process of moving bulk cargo from one mode of transportation to another.
So in this case, transferring heavy industrial materials from rail cars onto river barges or vice versa.
Exactly. Tidewater doesn't sit on an island. Its facilities plug directly into FIP's newly acquired Wheeling and Lake Erie railway network.
So think of this like buying a missing puzzle piece. If you have that puzzle piece sitting on a table by itself, sure, it's worth $9 million a year in transloading fees.
Right, standalone value.
But because that piece perfectly connects your massive 1,000-mile railroad directly to the navigable river systems, it completes the whole picture. It makes the entire logistics puzzle worth exponentially more to an energy client.
That analogy perfectly illustrates the strategy. Let's say you are a shale gas producer in the Appalachian Basin. You need to get your product from a well in Pennsylvania down to a refinery on the Gulf Coast. Historically, you might have to hire a trucking company to get it to a short-line railroad, then negotiate with a Class I railroad for the long haul, and then pay a third-party transloading facility to put it on a barge.
That is a logistical nightmare with 4 different middlemen taking a cut of your profit.
Exactly. But now FIP can walk into that producer's office and offer a single, seamless solution.
We load it onto our wheeling trains, we run it down our own tracks, and we use our own newly acquired Tidewater facilities to transload it directly onto the barges.
Right. FIP captures the entire logistics chain. They dictate the pricing end to end, they eliminate third-party bottlenecks, and they capture the margin at every single step of the journey.
And this connection between rail and water, this seamless transfer from track to port, isn't just the strategy for Tidewater. It is the exact overarching blueprint for their broader terminal tailwinds.
Yeah, we have to talk about the terminal side of the business. Because FIP is no longer just a railroad company. They are a rail and deep water terminal company.
And that specific combination of physical assets creates an incredible structural moat around the business.
It really does. If you map out the defining characteristics of FIP's remaining core terminal assets, specifically the Jefferson Terminal located down in Beaumont, Texas, and the Repauno Port and Rail Terminal situated up on the Delaware River in New Jersey.
Right. What do they have in common?
The unifying key feature is the physical integration of rail switching and deep water access.
It sounds simple, but you really cannot overstate how rare that physical integration actually is. You cannot just wake up tomorrow, secure a few $1 billion in venture capital, and decide to build a new railroad connecting to a brand new deep water port.
No, it is functionally impossible in today's environment. You are dealing with extreme land scarcity, a permitting process that spans decades across multiple federal and state agencies, and just astronomical capital requirements.
Yeah, the barriers to entry are huge. FIP already owns these strategic, fully permitted footprints. They possess the golden tickets. So what are the specific, tangible growth drivers for these terminals? Like, what is going to generate the massive cash flows required to justify this entire corporate turnaround? Let's start by looking at Repauno in New Jersey.
Okay, so the massive catalyst driving the valuation at Repauno is their ongoing Phase 2 expansion. What makes the Repauno facility structurally unique is its geology.
The underground storage, right?
Yeah, it utilizes massive underground granite storage caverns situated right on the Delaware River. They are currently deep into the construction of this Phase 2 expansion, which is specifically engineered to target a throughput of 80,000 barrels per day of natural gas liquids, commonly known as NGLs.
I want to pause on that because the physical mechanics are wild. We are talking about blasting and carving out massive caverns deep inside solid granite bedrock, specifically to store millions of gallons of highly pressurized liquid energy.
Right, and it's right next to a deep water dock that can load international shipping vessels, which is also fed directly by a rail yard.
It's an incredible piece of infrastructure engineering.
It is a total marvel, and the financials tied to it are just as staggering. When this Phase 2 NGL expansion is fully commissioned and comes online, which is currently slated for early 2027 management projects, it will generate approximately $80 million in new annual EBITDA.
$80 million annually. That is an enormous injection of high-margin cash flow directly into the parent company.
Huge. And while Repauno is grinding through construction toward that 2027 payoff, you have the Jefferson Terminal down in Texas acting as the anchor today.
Right. Jefferson is providing this rock-solid, stabilized baseline of revenue right now. The CEO noted on the earnings call that Jefferson is currently in advanced negotiations for over $50 million of incremental annual EBITDA potential from new throughput contracts.
And what is particularly noteworthy about Jefferson is the diversification of the product mix. One of the major new contracts they highlighted is for ammonia transloading.
Ammonia, because
Yeah.
the global demand for ammonia is surging due to its applications in agriculture and as a carrier for hydrogen energy.
Right.
And the best part for you listening and tracking this, the CEO emphasized that they can take on this new $50 million in business with little to no incremental CapEx.
Right, they don't have to build a new facility. The pipes, the holding tanks, the rail spurs, and the dock access are all already there.
Which brings us to a foundational concept in infrastructure investing: avoiding greenfield friction.
This is why FIP's overarching strategy of expanding existing footprints matters so much. When you try to build a brand new facility on an empty plot of land, a greenfield project, you face massive ramping friction.
Right, because before you pour a single yard of concrete, you spend 5 years in court.
Exactly. You endure multi-year environmental impact reviews, brutal zoning battles with local municipalities, supply chain construction delays, and massive cost overruns.
It totally kills the internal rate of return on invested capital. But FIP operates brownfield expansions.
Right. Because they are expanding existing historically industrialized footprints, they largely avoid that friction. They already hold the heavy industrial zoning and the foundational environmental permits.
They simply need to amend them to add a new manifold or a new tank to a site they already control.
And we have to acknowledge the reality of the business environment today. Regardless of where you fall on the political spectrum regarding environmental regulations, the factual reality for an infrastructure company is that permitting new land for hazardous materials or heavy industrial use is a grueling, often decade-long process.
Yeah, it acts as an artificial cap on supply, basically.
Yeah.
By owning assets that are already grandfathered in or already hold the necessary permits, FIP controls incredibly rare real estate.
It provides a speed-to-market advantage that any new market entrant simply cannot replicate. They can sign an ammonia contract on Monday and begin flowing product in a matter of months rather than years.
Okay, let's zoom out and put all these puzzle pieces together.
Yeah.
If they are generating all this new cash from the internal rail synergies and they are capturing the 5x multiple on the Tidewater ingestion.
Right, and they have these massive terminal expansions coming online in Texas and New Jersey.
And they just saved a fortune in interest by paying down that 9.75% corporate debt with the MRR money. So what exactly is the new playbook for all that freed up capital?
Well, this is where we dissect the company's new structural financial power, because the numbers are striking. By executing the Long Ridge sale and preemptively paying down that $300 million term loan FIP, projects a massive reduction in their corporate fixed charges.
What are the exact figures on that drop?
They are dropping their annual interest obligations from $132 million down to $103 million.
That is nearly $30 million in pure unencumbered cash flow freed up every single year.
It's massive.
It's like getting a $30 million raise just for refinancing your house.
And to fully appreciate the impact of that $30 million, you have to contrast the old FIP against the new FIP.
Right. The old corporate structure was a trap. It was severely constrained by excessive project-level leverage.
It's exactly. They were a capital-intensive conglomerate paying exorbitant interest rates to keep various entirely unrelated infrastructure plates spinning.
Power plants in one state, railroads in another, gas reserves somewhere else. The cash was completely trapped in a perpetual cycle of debt servicing.
They were playing defense every single quarter. But the new FIP.
The new FIP, armed with this interest expense relief and a stabilized balance sheet, can finally pivot to playing offense. They can act as a highly disciplined capital allocator.
Right. They aren't trying to be all things to all people anymore.
They have a playbook now. The CEO explicitly mapped this out on the earnings call, noting that 2026 is expected to be a highly active year for rail M&A.
And there are very specific macro-structural reasons driving this consolidation. On one end, you have the massive Class A railroad mergers, the giant continent-spanning railroads like Canadian Pacific and Kansas City Southern.
Right, and when they merge, federal regulators often force them to carve out and sell smaller branch lines to prevent monopolies and maintain market competition.
And simultaneously, on the other end of the market, you have private equity and institutional infrastructure funds that bought up portfolios of short-line railroads a decade ago.
Yeah, these funds have mandated 10-year or 12-year lifespans.
Exactly. They are hitting their exit periods and are contractually forced to sell their assets to return capital to their limited partners.
Which creates an absolute buyer's market for an operator with a clean balance sheet and cash on hand. FIP is perfectly positioned to deploy its residual proceeds, the cash left over after the debt paydown, combined with that $30 million in annual interest savings directly into these high-return rail acquisitions.
The Tidewater deal was not a one-off. It was the prototype. You can expect them to replicate that 5x multiple over and over again.
They will ingest complementary logistics assets, bolt them onto the Wheeling network, extract the synergies, and compound their cash flow, rather than sprawling back out into confusing, unrelated industries like power generation. So what does this all mean for you, the listener, tracking this company? We have an enterprise that made the hard choice to sell its biggest, most profitable asset to cure a crushing debt disease.
Right. They endured the operational pain of integrating a massive 1,000-mile rail network, and they are now sitting on a war chest of freed-up cash flow ready to deploy into a buyer's market for logistics assets.
Synthesizing the investment case, the final verdict from the analyst community is clear, right? FIP is actively and successfully transitioning from a distressed, over-leveraged conglomerate into a highly focused, specialized infrastructure consolidator.
Yeah, at current valuations, analysts view this as a structural value play for capital allocators who believe the management team has the operational chops to execute the final stages of this turnaround.
The summary analogy I keep coming back to is this. FIT has transformed itself into a sharpened logistics backbone for North American energy and heavy industrial connectivity.
They use the Long Ridge sale to surgically extract the heavy debt-laden fat. What is left is pure muscle and bone.
The spine. And that spine is an unreplicable network of rail lines and deep-water ports connecting the industrial heartland to the global markets.
It is a compelling thesis. But as rigorous investigators, we must ground this optimism with a strict audit of the execution risks. A turnaround of this magnitude is a high-wire act, and it is never guaranteed.
Yeah, we have to look at the downside. The SEC 10-K filings and the associated analyst reports outline 3 primary execution risks that could severely derail this thesis. Let's lay them out. What is the first hurdle?
The first and arguably most immediate is the rail integration success. Everything we discussed regarding profitability hinges on management actually realizing that $23 million in annual synergies.
Right. If they fail to untangle the administrative friction of combining the Wheeling and Lake Erie operations with Transtar, it falls apart.
Exactly. If they get bogged down in prolonged union disputes over seniority, if the IT systems face catastrophic integration failures, or if locomotive maintenance gets bottlenecked, those theoretical cost savings will just vanish.
And without those synergies, the operational drag of the rail segment will tank the overall margins of the company. That is the peril of the integration paradox.
You accept the short-term pain of higher costs, but if you fail to execute the merger perfectly, you never get the long-term gain. You just stay in pain.
What is the second major risk?
The second involves the Long Ridge exit timing. We've been discussing the $1.52 billion sale to MRI Holdings as a done deal, but it is currently slated to close in Q3 2026, and it is entirely pending regulatory approval.
Ah, the regulatory rubber stamp.
Precisely. Any friction or delays in that regulatory approval process mean the closing date gets pushed back. And every single day that closing is delayed, FIP continues to bleed massive interest payments on that $1.16 billion of subsidiary debt.
Plus the $300 million term loan they plan to pay off. The thesis relies on stopping the bleeding now. If the regulatory review drags into late 2026 or 2027, the liquidity squeeze tightens right back up around FIP's neck. So speed is everything. And what is the third execution risk?
The third involves sector-specific terminal headwinds. While avoiding greenfield development is a huge advantage, existing energy terminal markets face constantly evolving and highly stringent regulations.
Right.
A prime example highlighted in the risk disclosures is the regulatory fallout following the 2023 train derailment in East Palestine, Ohio.
Yeah, that disaster changed the entire landscape of rail safety.
It did. Because of that incident, there is now an accelerated federal mandate dictating that the transport of highly flammable liquids must transition to newer, significantly safer DOT-117 tank cars by May 1st, 2029.
Right. And for those not deep in rail logistics, the DOT-117 cars have significantly thicker steel shells, enhanced thermal protection blankets, and redesigned bottom outlet valves to prevent catastrophic leaks during a derailment.
Right, meaning the older legacy fleets, specifically the CPC-132 tank cars that have been the industry standard for years, are being completely prohibited from carrying these liquids.
And Fitz Jefferson Terminal heavily utilizes fleets of these legacy CPC-132 cars for their current operations.
Exactly. The capital costs associated with either retrofitting their existing railcar fleets to meet these new DOT 117 standards or leasing entirely new compliant fleets are massive.
When you combine those retrofitting costs with stricter mandated operational controls like heavily reduced train speeds through urban areas, which slows down throughput.
It could put significant downward pressure on the operating margins at both Jefferson and Rapono over the next 3 years. It is a real, unavoidable capital expense looming on the horizon.
So the picture is clear. They have the brilliant macro strategy, they own the irreplaceable physical assets, and they have the cash infusion from MARA. But they have to execute flawlessly through a highly complex maze of operational integration, regulatory approvals, and stringent environmental compliance.
If they stumble, the debt catches back up to them. But if they pull it off, they emerge as an absolute cash-flowing powerhouse in North American logistics, which raises an important question for you to mull over as you continue to track this company's evolution.
What's that?
Let's look past the current integration phase. Fast forward to late 2027. Assume the Rapono Phase 2 cavern expansion is fully operational, the NGLs are flowing, and the terminal segment is actually hitting that massive $80 million annual EBITDA target.
Okay, assuming all goes right.
Management has already vaguely hinted on recent earnings calls about evaluating monetization strategies for these terminal assets once they mature.
Wait a minute, are you suggesting they might sell the ports, the very assets they just spent years building the moats around?
It is entirely possible. Think about the long-rig playbook. You build an asset to maturity, you prove its cash flow, and then you sell it at a massive premium to an institutional buyer who wants a de-risked turnkey operation.
Right.
If the terminals are fully mature and generating maximum cash, FIP could sell Jefferson and Rapono for billions. Could the ultimate endgame for FIP be to spin off the ports entirely, take a multi-billion-dollar windfall, and use that capital to aggressively buy up even more rail lines?
Transforming into a 100% pure-play North American Class II railroad monopoly, a completely dominant, unavoidable toll road for heavy industry.
Exactly.
That is a fascinating endgame to watch for. It changes the entire perspective on what this management team is actually trying to build over the next decade. Thank you for diving into the financial trenches with us today and exploring the mechanics of this corporate rebirth. Risk defined, portfolio protected.